Let's talk about why you're broke. And it's not because of your questionable life decisions, like the time that you bought cryptocurrency named after a dog, thinking it was the financial equivalent of contributing to your 401k plan. The real villain here is actually far more boring, which somehow makes this much more offensive, and I am talking about the bond market, a $100 trillion snooze fest that controls your money while wearing the financial equivalent of khaki pants. Now, what are bonds? Bonds are essentially the world's most depressing game of IOU. When governments and corporations want money, they don't just ask nicely. Instead, what they do is they print up a bunch of fancy IOUs, which again are called bonds, with the promise to pay back some sort of interest, maybe like 3%, which is $30 off a $1,000 loan. And maybe you're thinking that's good for them because how does this affect you? But suddenly your mortgage rate, your job security, and even the price of your precious Netflix subscription are all at the mercy of this glorified debt bazaar. The US government, for example, has racked up a staggering $36 trillion of debt this way. And that is enough money to buy every single NFL team 1,000 times over. Or more precisely, to fix one pothole in your neighborhood. And here is how the bond market hostage situation works. When the US government needs cash, which is always, it doesn't beg you. It instead auctions off bonds like it's a big game of eBay. Investors then just bid on what they're willing to pay. And here is the dirty secret. They absolutely can demand higher rates. Think of it like this. When inflation is high, bond investors say, your 3% makes me poor. Make this 5% or else I'll buy Bitcoin instead. When the US economy looks risky, i.e. a huge national debt that teases its inability to repay lenders, they scream 7% or else we're going to China. And if you know anything about geopolitics, then you know that the US would absolutely hate that, because they're rival superpowers and they kinda just don't get along. At this point, then the US Treasury has no choice but to pay up. Because unlike you, and I emphasize, unlike you, they just can't stop borrowing. It's like your candy-addicted 5-year-old who just can't stop getting cash advances from you because they used up their weekly candy allowance already by Monday. Now this is where your wallet gets mugged by the US government. When the US government raises its interest rates to pay higher returns on bonds that it issues, which again is the money that it borrows, the Federal Reserve usually follows suit and increases their rates. Why? Because they are trying to control inflation. And when the Fed hikes its rates up, it makes it more expensive for consumer banks to borrow from them. And remember that the Fed is a bank to the banks. So these are banks that include our local banks such as Bank of America, Wells Fargo, any other local ones that me and you use. Now because they have to pay more money, they're going to pass down those costs to you. And it's not like these banks are nice little angels who are like, I totally understand if you're already having financial struggles, so let me go ahead and eat this cost. In reality, the banks pass down these extra costs by making the loans they give out more expensive, which can impact you, let's say mortgage rates, if you're looking to buy a new house, if you're looking to refinance your current mortgage, if you're looking to buy a new car, or even a used car with a loan. This can also impact your employer, because businesses usually borrow money to help fund their operations. And that's why you have situations where the CEO is apologizing to the team, saying things like, sorry guys, no raises this year because JP Morgan wanted a new yacht. But at least we only had to lay off half of you, while giving a teary-eyed speech about making tough decisions.
Well, Braden Wally, the CEO of marketing firm Hypersocial, is going viral after posting a selfie of himself crying on LinkedIn to go along with a post explaining his experience laying off several employees.
To add insult to injury, 401ks or pension retirement funds are stuffed with old 3% or low-paying bonds. Now that the government is offering more expensive ones, say the 5 or 7% bonds, nobody wants your trash bonds, so your savings just got dinged again. And here is where things get messy. The Fed does try to intervene, but it's like choosing between letting rates rise, which means the recession is going to happen and obliterate your job, or keep rates low, which means inflation turns your paycheck into confetti or into monopoly money. So in the end, it all comes back down to you. The brutal truth here is that you're stuck funding the circus because tax dollar that you pay ends up in the hands of bondholders, some faceless investor in Zurich who doesn't even know your name. The bond market isn't just Wall Street's casino, it's the entire economy's puppet master. And here is the kicker. You can't even opt out of this financial mess even if you wanted to, because you are essentially Venmoing your hard-earned money to that faceless investor. And while that's happening, you're at the grocery store debating whether you should splurge on fancy ketchup or again buying the generic ketchup just so your kids can go to college. So what is the solution then? Well, you could become a bond trader yourself, but let's be real. If you had that kind of patience, you wouldn't be sitting here watching this video. You'd be a Shaolin monk already. And the rest of us are playing financial dodgeball, trying to avoid getting smacked in the face by the next interest rate hike. At the end of the day, the bond market is just another way the financial system extracts wealth from the many and funnels it to the few. The difference is that this time it's happening in slow motion with spreadsheets. So the next time you're staring at your bank account wondering where it all went wrong, just remember that this time it's really not you. It's the $100 trillion debt monster that lurks in the shadow, quietly eating your paycheck. But here is the truth. There are ways to still navigate this bond market chaos. Whether you want to protect your savings or even profit from this mess, but it requires understanding the rules of this rigged game. So in upcoming videos, I'll dive deeper into how rising rates actually create opportunities and not just pain and sorrow. The 3 assets that thrive when bonds crash. And a hint is that one of them is in your pocket right now. And why most bond alternatives are traps. So that's about all I have for this video. Thank you for watching. And if you want to stop being financially puppet mastered, then hit that subscribe button. And let me know in the comments what else I should cover.